Everyone, it's Ben here, and today we're going to be going over a stream for Alphabet, aka Google. I kind of use the names interchangeably because I just like calling them the company Google, even though I guess technically I should be calling them Alphabet. And I wanted to, looking at today's agenda, if you've been following these streams that I post on my channel, you'll know that we typically go through like situation overview, do the DCF and talk about the price and stuff like that. I wanted to add two new things today, which is looking at trading comps to see how Google is trading. And then later we're going to do sensitivity tables. So this is kind of the agenda, and really quickly going into the bull case and bear case for Google. AI is kind of an existential threat, so it's kind of like a bull/bear case. If Google is able to be very successful with Bard and kind of catch up or surpass ChatGPT, then that's like a huge potential bull case for Google. But Bard has a lot of mixed reviews. So does ChatGPT though. And of course, there's a lot of other competition that will probably come our way. But yeah, this could be a huge new revenue stream for Google, or it could take away a lot of revenue from Google. Like for example, I actually use ChatGPT instead of Google Search a lot these days. And then Google Cloud, YouTube, and Search are still going strong for now. And in terms of the bear case, ChatGPT versus Bard versus like other competitors, who will be the real winner? That's like a huge question, as I mentioned. And then in terms of the macroeconomic environment, just in case, people watch this later down the line, maybe a year or a few years down the line, then right now interest rates are going on the rise. I kind of think a lot of the different parts of the economy are kind of screeching to a halt, but it may take some time for a lot of this to actually be reflected in the stock market. Or, who knows, like things could keep rallying up, but I definitely don't know like exactly what's going to happen, but I think generally the macroeconomic environment is very shaky, and no stock is safe if we see like a market downturn. So let's next quickly look at Google stock and see how it's been doing. Overall, Google has been like a super, super great stock to hold. The last time I did this DCF actually was before the stock split. So now Google has done the stock split, so it's at 138.8. If you look at even this past year, even though the markets have been kind of shaky, Google stock has been doing really well. And then the reason I also wanted to do this DCF today is because Alphabet is actually reporting earnings at the market close. So I'm going to have the DCF that that you guys all see today. It's going to be available for free to download after I finish the stream. And if you are interested in Google stock and you're like modeling it out, you can download the Excel, like play around with the assumptions and kind of like think, include your own thoughts. And then you can purchase Google stock if you want, or, hopefully this is helpful in your analysis, I guess is what I'm trying to say. And so before I go into trading comps, just a few quick notes and reminders. One is, as I mentioned, I'm going to repeat this a lot throughout the stream just because I know people kind of watch different parts of it. But this model will be available for free to download. This is also a high-level street-based DCF and not financial advice. So sometimes people look at the model that I build and they're like, "Oh, how come like you don't go dig deeper? Or how come you're just looking at percentages of the street or whatever?" Well, in order to do like a really, really proper DCF, then you probably will want to have like a very detailed revenue stream for any company that you're modeling for. And that requires a lot of different assumptions that people just don't have a lot of access to. So I think for the vast majority of people, having just like a street-based DCF still is like pretty helpful to just kind of have and use as part of their analysis. Next, the financial statement, Excel shortcut, DCF tutorials, all of that, if you want to learn more, is down in the description below. Another thing I wanted to point out is if you go onto my channel, I'm going to just continue having all of my DCFs in this tab live. So if you want to check out like other companies, it's going to be a little bit old, and the free Excels are actually only for these two for now, and all these other old ones, they won't actually just be available. But starting from now, all the DCFs will have Excels that you can download for free. And so that was that one. And then lastly, if you're interested at all, working on an investment banking course, there's a link for that down in the description below. Now, with that said, let's go into trading comps. So I have a tutorial for what trading comps are, but to really briefly go into it, in essence, it's a valuation methodology where you're kind of looking at growth rates, margins, and trading multiples. And what you're trying to do is look at a peer set of companies, so companies that are similar to one another, and that can mean like they're in the similar industry, have similar growth rates, margins, similar sizes, and then you compare their trading multiples, which you can see here. And then these multiples basically just kind of show whether or not a company is expensive or it's trading high versus if it's cheap. And in an ideal world, you want a company in a peer set that has really good revenue growth, really high margins, but is trading at low multiples. Now that could definitely mean there's something else going on with the company, but that is the ideal, right? You want to be able to buy a company that's growing quickly, is very profitable at a lower price than you do other similar companies. So for the peer set for Google, I just pretty much took some of the big tech companies. This is not a perfect peer set, but I think it is kind of instructional. And so as you can see here, this is like the market cap for the companies. Google is, I'll just bold it so it's kind of easier for everyone to see. It's pretty much, it's the third largest company in the world. And in this column here shows like the percentage of 52-week high. So based on the past year, based on Google's current trading price or share price, what percent of that is out of the 1-year high? So Google pretty much is trading at the highest point compared to the past year. In an ideal world, you'd want to see, something pretty low, but a company that has is not trading at its 52-week high kind of, but has good growth margins and low multiples. But that's pretty rare. Companies usually trade at a high price for a reason, and there's no reason that just because they're at a 52-week high that they can't go higher with good performance. So drink some water. And I promise I'll get to the chat, but I'm actually curious to know, before I kind of go into more of this, if you guys have used Google Bard and if that's been more helpful or a useful tool, or if you guys think ChatGPT is better. So let me know what you guys think in the chats or in the chat. So next, looking at revenue growth, we can see that NVIDIA is a huge outlier. It just did a DCF for them recently, I think 2 weeks ago or 3 weeks ago. Google is growing at 11%. They're one of the largest companies in the world. So even the fact that they can grow double digit in 2022 to 2023. Oh wait, actually, sorry. I just realized I made changes to this file, and I forgot to change this. So let me quickly change this. It's my bad. So I updated a lot of these numbers. This should be 23. This should be 24. Okay. One thing about trading comps is that they're always forward-looking, meaning that you always want to be looking at the future growth rates, margins, and multiples for these companies. And the reason for that is because when you're looking at any stock, you don't really care about you do care about the past and how the company has performed, but what really matters is how the company is going to perform in the future. Just to give you an example, just because some company is at the top of the world doesn't mean that its stock is safe. And we kind of discussed that with Google, right? Let's say ChatGPT just blows like all other companies in the AI space out of the water in the next 10 years, and everyone is using ChatGPT instead of Google search, then Google's business is just going to be on a huge decline, right? And then so that means that if let's say OpenAI becomes like a public company, then that stock, if you believe that they're going to dominate, then you would want to invest in that company, even if Google has been doing well in the past. And so that's why when we're looking at trading comps, you always want to look into the future, and you can look at the past, especially when you're modeling, because it's helpful. But for trading comps, the future is what's most important. So as I was mentioning here, just looking at these growth rates for being one of the largest companies in the world, having double-digit growth rate is pretty good. Margins also look very solid for Google. EBITDA margins of 41% is nothing to scoff at. There are companies here that are a bit higher. Interestingly, like Facebook/Meta is still very high, even though they've been having like a lot of layoffs and things like that. Adobe also looks pretty good. But overall, I'd say, pretty solid margins for sure. Even like any company that has 40% EBITDA margins, it's very, very solid. Profit margin, somewhat similar, 24-25%. Not the highest out of all these, largest tech companies in the world, but still very good. And then free cash flow yield looks like it's one of the top amongst its peers, which is really good. Free cash flow yield is kind of similar to profit margins and EBITDA margins, where you're just looking at your free cash flow. And I guess kind of like, let's look at the formula because that might be easier to explain it. So this is also what a database might look like when you're on the job in banking. You have like all these numbers, all these companies, and then you have like a database essentially, and you have like a nice little output here. So free cash flow yield is your free cash flow, which I define as EBITDA minus CapEx divided by your market cap. So essentially, how much is kind of like, if you think of market cap as kind of like your price, then it's basically what we're kind of thinking is your free cash flow divided by like how much you're paying, and that's kind of like your yield. Okay, so next we go into what's kind of most important with all this, right? Which is your trading multiples. So you do want to be paying lower multiples if possible, because what that means is for Apple here, you're paying $24 in essence for every $1 of EBIT. So that's what a 24 EBIT multiple means. 21.8 for an EBITDA multiple means you're paying $21.8 for every $1 in EBITDA that the company generates. For PE, you're paying $27.9 for every $1 in earnings. And we can see that Google here is actually pretty low compared to its peers in terms of their multiples. And so what that, this could mean various things. Like sometimes investors know something, and they, even if a company has like good margins or whatever, maybe they think in the future the company won't do well. They're privy to some information that us normal retail investors don't know, and so they pull out of a stock. Other times, like with these like high multiples, you can just see that this is why everyone says like Tesla's overvalued, because they're trading at such high multiples compared to what the company's actually earning. One counterexample, which I don't think like is actually super valid to always bring up, but people always do, is like, okay, Amazon for the longest time traded at super crazy multiples, and the company just kept growing and growing, right? But you can't always rely on that for all companies. So, but the key takeaway here is that Google is trading at very reasonable multiples compared to its peer set. So that's pretty interesting. And it could mean that this is kind of like instructional for the DCF we build. It could be that what we get to in terms of valuation, I predict right now without having built the DCF, is I think it might be fairly priced right now. And so that's like kind of like my takeaway from all this. Last thing I'll mention, this isn't like super common, but I think it is something that's pretty interesting, is you can look at your premium or discount to historical multiples. So what this basically is when you think about these multiples, they change constantly over time because, you know, stock prices are changing all the time. And so what this basically does, or what I've done with some of the data in my database, is we're taking a look at, is the company trading at a premium to its historical multiples or a discount? And of course, you want things to be at a discount. You want to be paying less than what other investors have been paying in the past. So looking at Nvidia, for example, right now, they're over the past 1 year, and the EBITDA multiples people were paying right now, currently, as of October 24th, 2023, Nvidia is trading at a 32% discount compared to what investors have paid in the past year. So that's like a positive thing. Again, you don't want to just look at one of these metrics and be like, oh, like we should buy the stock. But all of this like kind of put together is helpful when you're doing any kind of like equity analysis, essentially. So I'm going to now go to the chat, see if there are any questions before I move on to the actual DCF. So let's see, I'm reading through, watching your content for a while, I've learned a lot. Was wondering if you had any career advice for, okay, career advice. I promise at the end, I'll leave some time for career advice if you have any questions about that. But I do see a question about, you should put EV, EBIT, and EBITDA when you're done doing the DCF based of your enterprise value for the next 5 years, and then compared to FactSet. Would be an interesting, oh yeah, could do that. Okay, so I don't think there's like any other questions really. So we went to trading comps. Next, I wanted to discuss today's sponsor for the video, Wall Street Prep. And they're a company that has been training a lot of the top institutions, banks, students, and just kind of people who want something like more self-taught, just online. They have been one of the top like financial modeling trainers since 2004, so a really long time. And actually right now, getting my MBA at Wharton, and a lot of my classmates are going to like live instructor sessions to learn how to build financial models, either before they start recruiting or they've already gotten an offer at, let's say, like Centerview, JP Morgan, Morgan Stanley, etc., and they just want to prepare in advance of their summer. So very, very just like credible company in general, and you can see me here actually with like a little review. So they have a buy-side financial modeling course that I think is really interesting. So they kind of recently launched it. You can use my code RareLiquid to get 20% off, but it's taught by Brett Kovron, who worked at Maverick, DE Shaw Capital, and Citadel. And so if you know anything about the different firms and kind of buy-side shops, you know that especially like DE Shaw and Citadel are just super, super top companies. And so you're being taught by an actual experienced hedge fund professional, and you're not just learning about like how to build kind of more high level financial models, but if we go through the table of contents, there's a lot of stuff in here. So process driven investing, he kind of just goes over different use cases, different ways to kind of just giving like an overview of what it's like to invest when you're on the buy side. And then like buy side model construction, there's like templates you can use, very, very detailed, like kind of revenue builds, looking at like financial statements or how to look at financial statements when you're like on the buy side, like how to analyze a business. Then there's like buy side forecasting frameworks, buy side valuation, which I'm sure is what a lot of you guys are interested in if you're watching this video. And then like buy side thesis development. So this is like more kind of in depth. And if you want something that's a little bit more about like high level, I guess, there's the financial and valuation modeling certification program. And this goes over a lot of what I learned when I was in banking. So financial statement modeling, DCFs, accretion dilution models, trading and transaction comps, and LBO models. Feel free to check out any of this. If you'd like, use my code RareLiquid to get 20% off. So that is the sponsor. And then now I guess we just kind of go into the DCF. And it seems like my computer is lagging a little bit. I think it's because of my trading comps. Like this file, just to kind of show you guys how it's built. You see all these like, well, actually, yes, these figures of revenue, EBITDA, etc. Like these are all FactSet numbers. Like literally refreshing all these numbers takes around 20 minutes. So it's really like slowing my computer down. I'm just going to save this file and then exit out so I don't lag. I see a question of, is a template of trading comps okay to share? Unfortunately, I can't because it has a lot of like estimates and stuff like that. So I'm not supposed to share it. Okay, but let's now build out the DCF. Okay. And do you take SBC in your analysis? I don't. And let's discuss it later when I go through cash flow items. I also see a question of, can I ask you something in Korean? You can, but my Korean's not super great. Okay, so what do we need here? We need a ticker, date. We're gonna need, eventually when we're doing mid-year convention, we're gonna need the year end. And let's get this formatted. Today is the 24th. And as I'm kind of setting things up, curious to know where all of you guys come from. So let me know in the chats like where you guys are watching from. Let's just make it 10. Okay, so I'm going to take a quick little shortcut and copy paste one part, which is the assumptions from a previous DCF that I built. I see the video is not so clear. Is that just for Satyam or is it for a lot of you guys? Hopefully when you guys are able, like once this stream is actually published, you can change the settings so that the stream is like at, I don't know what you call it, like 1080 or something like that. Okay, so I'm just going to delete all of this. Not sure exactly what we're going to use yet. Oh, wow. So I see people from kind of all over. Interesting. Sweden, Korea, Berlin, Boston, China, Nigeria. Okay, I see a request to zoom in a little bit, which I'll do. All right, so we have our assumptions. The first thing we're going to want to do is get our figures for our income statement. So that's going to simply be our revenue and then percent growth. Oops. And then we're going to have our EBIT, which we'll have as percentage of sales. And for the years, so I kind of already went and got some of the information we need. I have it since 2013, but I don't think we're going to need to really go that far back. So let's just do it from 2018, so around 5 years back. You can see what that looks like. And let's add here. So A will be like actual and then E will be estimates. I was actually recently talking to one of my friends who worked in private equity, and for the longest time, I probably should have known, but I didn't know how to really quickly get to Wait, what just happened here? Okay. I didn't know how to really quickly get to this thing, which is just if you press Control 1 if you're on a PC. Probably should have known that a while back. Okay, but let's go to our income statement. So starting 2018, we get our revenue. I'm going to make this green because for models, you always, at least on the job, if you're in banking, you want to color code it so that it's easy to audit the model. So green just means that you're linking to a different sheet. If you have been watching these streams before, then you do know that I've mentioned this before. Okay, so we have our revenue growth. Very interesting, right? 18%, 13%, 41%. This was really probably because of COVID, and then 10%. A lot of times if you see these huge random jumps, then it usually, or a lot of times can be because the company acquired another company and added that revenue into their, income statement. In Google's case, I don't think it's because they acquired a company. I think it's just because of COVID and they just saw a huge boom. Next for EBIT, that is our income from operations. So let's get that from 2018. I'm going to copy the formatting, and just as a friendly reminder, if you're looking at what I'm doing right now and you are thinking to yourself, I want to know the shortcuts, I have like a tutorial you can find down in the description. Okay, so that's some of the figures that we need. And I also want to add, I want to add estimates from equity research analysts. So let's do that. And this is also something I always used to do when I was working at JPM, in terms of just like going into FactSet, finding like analyst numbers to include and all of that. Consensus, I think maybe it was estimates. And a lot of firms still either use CapIQ or FactSet. I'm just super used to FactSet, so that's why I'm using this. So for item, we want sales. Means fine. Annual year, we're going to want it as of the year that we're in. It is available, etc., etc. Okay, I think this is fine. So one thing I like always forget is we need to anchor this cell by pressing F4. And we want to make this red. So red for my color coding just always means that you're kind of doing something different or maybe a little bit weird. So that's what red means. And you can see how far analysts project revenue for Google here. Okay, I see a question. Do you ever project out COGS and OPEX? No, because it's... I mean, maybe I should try to do that one day in the future for some company, but it just takes like so much time and like a lot of research. So I like to try to keep things simple, and keeping things simple still takes like 2 hours. So maybe in the future I'll try to do that. And then now let's get our operating income estimates. So that, I think it's under operating income or it's under EBIT. Oh, very long. I think I missed it. Okay, it's under EBIT. mean, and then year. We're looking for this. And anchor, again, Google. Okay, now I can exit out of this because I think I have what we need. All right, so we have our figures, and if you kind of, whenever you look at, you ever like get estimates, or for me, whenever I did, I would always check to see if it makes sense, right? Sometimes FactSet is just, and CapIQ, things can get really funky, and you can just like get really weird numbers. For us, it seems like the numbers make sense, right? Like sometimes you might like enter something, and then your number here could be like 200,000, 200,000. And these are all in millions, by the way. So this is 282, is that 82 billion? Yeah, 282 billion in revenue. Is that right? Yeah, it's got to be. Wow, that's actually pretty crazy. Is that right? Let's check. I think it is, but you know, when these companies are just so big, I just like, it's hard to wrap your mind about how much these companies actually make. Okay, so these are in millions, 282. So this, yeah, $282 billion. Wow, that's so crazy. Okay, anyway, so income statement. Now we have our items here, and let's just kind of audit the numbers to see how long we can rely on the estimates for. So if we go into Broker Outlook on FactSet, let's go to sales, and then we can go to, okay, so for Google's 2023 revenue estimates from all these different banks or like equity research companies, you can see that there's a ton of companies, and Google's third largest company in the world. So that's why there's just like a ton of analysts that cover the company. And then we're basically just trying to see until when is there like a huge drop off. 2024, no surprise, there's a ton because it's only 1 year out. 2025, same thing, it's only 2 years out. Looks pretty reliable to me. 2026, you can see that there's a huge drop off. So 2026, not reliable. We'll basically have to rely on our own estimates instead of relying on these numbers. And then just kind of sanity check, 414 here, and 2026, 414 here. So it looks like we have our numbers correct there. All right, so we got our income statement line items that we need. And next, let's just get our cash flow items. So this will be our DNA, CapEx, then change in net working capital. All right. So let's go into our cash flow statement, 2018, our depreciation. Looks like there's a line for depreciation and amortization of intangibles. So there was a question earlier about stock-based compensation, which is a little bit of a complex subject, and there's like some debate around it. So what stock-based compensation is when you are paying your employees, you pay them their base salary, which is just like cash every month, right? Like the paycheck you pay people. You can give people bonuses, and then you can give people stock options. And the stock options for public companies like Google are very, very real. Like you're actually giving stock, and that stock can be converted into cash, right? Because if you get stock options, you can actually just sell the stock, and then that becomes actual cash for employees who get stock options, right? And then for private companies, stock-based comp is a little bit trickier because you could give stock of like a private company, but then it's not as liquid. You can't really like sell private shares as easily, or if you do, like it could be at like a discount. I don't know. Like there's a lot of complications with that. So generally speaking, like when I'm doing a DCF, I don't treat stock-based compensation. I don't include it as like a non-cash expense and like add it back essentially. I just treat it as like a real expense because at least for these public companies, it's a real expense, is how I basically would interpret it. It's not like a fake expense where you can just kind of add it back, because there is opportunity cost. Like if you were not to give those stock options, then you could use that stock and like sell it for whatever and like raise funds and actually use that cash for other parts to fund other parts of the business. So that's kind of how I learned it. But, you know, in the chats, let me know if you guys view stock-based comp a little differently. Also, while I'm working on this, let me know what company you guys want me to do next for these streams. Interested to know what you guys want to see. Okay, so we have our DNA. Then let's get our CapEx, which is our purchases of property and equipment, 2018. So since these are negative numbers, I like to keep everything positive, and that's totally just based on preference, but I like having everything positive, and then I can just decide which ones to, you know, subtract and add. Versus if you like have what's negative as negative, sometimes I think I'm more likely to make mistakes. And that's just because you're always going to have to pay attention to like where the signs for every single kind of cell. So change in net working capital. Let's get our cash flow statement. We luckily have that right here. Changes in assets and liabilities. So there's that one. So we can have it as a percentage of sales or percent change in sales. That divided by our change in sales. Essentially, though, what I'm seeing is that net working capital, not a huge concern, like not a huge driver of this DCF. So to answer some questions in the chat, is this exactly what you build in JP Morgan? So the models that you build in banking, if you needed to build something really quick and if you need to build something really quick, then what we build today would probably be similar. But if you're usually, it's not just that the DCF that like is what's complicated, but it's rather that you're working with clients and their financial models. And so for us, we have like, you know, like very easy, clean numbers where we can just link to revenue, costs, etc., and cash flow statement, all that. A lot of times, if you imagine like what a company's financial statements look like or Excel models look like, a lot of companies are super, super messy. And that's just because like imagine you like are running a company and then you have like tens or hundreds of different products, different prices for them, different geographies, and then all of that kind of needs to feed from all these different sources from different cities across the world. And like you might have some accounting teams, I don't know, working with QuickBook, or like in very bad scenarios like Excel or like some other software, and then all of them needs to like kind of combine the central kind of like Excel model or whatever the company uses. Eventually, it needs to be put into an Excel model from like so many different sources, and then over time, there's always like little adjustments being made. So the models you get from clients tend to be pretty messy, and then your job when you first get the model is actually like diving into everything to see like if there are any big mistakes or errors. That's really the challenging part. When you're, going from after that, building the DCF, like essentially your goal in banking is once you get the client's model is to put everything neatly into something like this, like the income statement, cash flow statement, balance sheet. Once you have that, then you can just build out the DCF and it's like really no big deal. I say that's what's the challenging thing. What model do you use when you value a non-public company? Private companies are a little bit trickier. You can, if you have the information for historicals, then you can still do a DCF, but it depends like when that company is going to be profitable in your view. You can also look at trading comps, but a lot of times, trading comps, companies are public once they, achieve like some level of growth or scale. And so a lot of times like private companies are just like in a totally different sphere. So there's like some ways you can do it, like when, like the common one I hear of is when you're looking at when you were looking at internet companies back in the 2000s, you could do like enterprise value divided by number of like clicks on the website or something like that, and find multiples that way instead of like revenue if the company has a very low revenue or is like super unprofitable. But yeah, ideally you're able to just like kind of project out revenue and then like apply like a revenue multiple or something like that. Okay, so for Google, because it's such a mature company, I don't think we really need to rely on estimates. I think we can just look at the past 3 years where things have been pretty steady and make like a pretty simple assumption there. So now we can just kind of build out the DCF. So I'm going to write out all the items that we're going to need. And they're kind of actually what we've already found here. So our revenue, EBIT, taxes, so percentage of EBIT. And then that gets us to our EBIT, which is our earnings before interest and after taxes. And then let's get our cash flow items. So revenue, we can just link to up here. And I'm gonna, I forgot to make these green. I'm gonna color code this as purple. And purple means linking to a sheet or the same sheet you're already in, as opposed to green, which is like a different sheet. Okay, so we got that. I'm going to copy paste this formatting. Okay, EBIT up here. If you're wondering why I'm doing this again in terms of the margins, there is no good reason. I'm just doing it instead of linking. Oh, taxes. I forgot to add taxes. Okay, if we go to our income statement, we can see, hopefully they have taxes somewhere here. Okay, income before income taxes, provision for income taxes. sounds like this is what they paid. Provision for income taxes. Income before income taxes. So it should be this. So it looks like they were paying around 16 to 19%. Okay. Well, that's a percentage of EBIT, not necessarily like the exact tax rate. Let's actually see what the tax rate looks like. And by the way, a lot of times like the numbers you get from FactSet, they're in the right ballpark, but a lot of times they can be a little bit off. But it looks like in this scenario and this is interesting. They had like a huge tax amount they needed to pay this 1 year for some reason. But generally it looks like it's around like 16%. Okay. So taxes we have up here now. Okay, so now comes kind of like the trickiest quote unquote part of the model, which is sorry, when I'm multitasking, sometimes it can be hard to talk, which is making different cases for our revenue and EBIT. That's going to be where we spend like the next 20 minutes or so, maybe. And after that, the rest of the DCF should be pretty easy. So we're going to have our conservative case, base case, I'll call it street case, and then our optimistic case. And let's kind of indent this a little bit. All right. Oh, I also need to figure out how many years I'm going to project. So we have basically 2023 is almost over. There's like a month left. And then we have 2 years of like really reliable estimates, and then the rest, not really. So I would kind of consider this 1 month is not really a real projection. It's either a 5-year DCF or we do like a 10-year. I think given how large Google is, we can just do a 5-year instead of like a 10-year DCF. And so let's actually get rid of this. And in terms of deciding between like a 5-year and 10-year DCF, I think for me, when I see a company that's growing really quickly and is not extremely mature, then using like a long-term DCF that's 10 years probably will make more sense, because then you have more time for the revenue growth to kind of go more towards like your terminal growth rate, which I think is like generally good to see. For a company like Alphabet, because it's already so large, I could see it approaching like its terminal growth rate kind of sooner rather than later. With that said, let's see how like everything turns out. I see also I haven't been answering questions in the chat, so I'll answer some of the recent ones. So how do you copy paste the formatting without prompting the typical pop-up? Alt-ES. So Control copy and then Alt-ES pops, like has this thing pop up, and I could press T to copy paste the formatting. And then, oops. When you do it really fast, you can barely like see anything, I guess. And another Question, comment. No serious trader or investor ever looks at DCF model only for valuation. I agree. The point of this is not to be like, oh, look at this and invest because of this DCF that I built or whatever. A lot of this is like for various reasons. Maybe you're interested in investment banking. Maybe you want to just use this as like a tool to invest in stocks. And I would say it's really hard being a retail investor because you never really have the information that hedge fund investors have. And I know I have some friends in hedge funds, and I know like the level of detail that I don't know personally, but I know I have been told like, you know, what level of detail of information they have, like what kind of models they build. And a lot of times for a lot of hedge fund investors that are focused on equities, they actually look at companies on a quarter by quarter basis and are really reactive to company earnings. And then we'll make like trades like here and there based on that. For our purposes, you know, this high level DCF, you know, there's not much that you can, where you can get this kind of, even this kind of level of analysis if you are a retail investor for free on the internet or on YouTube. So yeah, hopefully this is like something at least somewhat helpful for you guys. Why 5 versus 10 years? Mentioned this to you, or I think I answered that already. Think about what's your risk-free rate. Will Fed reduce interest rate? What is beta? Yeah, we're going to do our WACC later, but very important things that we do need to consider. What do buy-side shops use for valuation? Like I said, a lot of times it's like on a quarter by quarter thing, and I think sometimes it could feed into like a very high level DCF, but it's more about, is this company like, actually, I don't want to act like a super expert because I'm not, but in terms of how hedge fund investors actually invest, because a lot of times they might just do like algorithmic trading and be looking at a ton of macro factors instead of like doing like this, like instead of like building valuation models, right? But I do think that still for generally they'll look at trading comps just to see like how things are trading. I think that's something that investors will always need to look at, kind of, if you're a fundamental investor. I should probably ask one of my friends, like, you know, like what kind of models you build on the job, and I'll try to let you guys know in the next stream. But as I mentioned, I do remember talking to one of my friends who worked in like healthcare at a healthcare hedge fund, and he just focused like every quarter when his companies that he would cover were releasing earnings, like he would be just so busy because he'd be listening to every single earnings call, updating his model to like figure out like based on the new numbers that they sent, like how much off or how correct he was with his predictions, and then based on that information like make some trades and stuff like that. So anyway, let's go into our projections for revenue growth. So we're going to start off with the street case. Because 2023, there's 1 month left. And for equity research analysts, when they're making projections, they're usually really not far off for the the year that they're in, because in our situation, 3 quarters have passed and we already have revenue figures or full financial statements for the 3 quarters that have passed. So now the equity research analysts really just need to predict 1 quarter. And so that's usually not like incredibly too hard, because the equity research analysts have been covering companies for a really long time. Usually they know, like, they're not usually like too surprised with things going on. They talk to management fairly frequently and like are able to update their models accordingly. So all that is to say, for 2023, since we have 1 month left, I'm just going to keep it as is and not make any changes. And I'm going to do that for each of the cases. All right, so 2023 is simple. Keep it at 7.8 or 8%. Then 2024, 2025 for our street case, we're just going to go with the street because as we discussed, like these numbers should be like pretty reliable. And this is really the foundation. The street case is the foundation for this entire model. And the whole point of this is like, okay, the street thinks in our base case, this is like the value for Google. But if we adjust and make things more conservative or optimistic, you know, like how does that affect our stock price? And like, what do we need to believe to basically invest in Google? Okay, so let's think here. I'm gonna hide some of this for now. Oops. So we can see everything. So, okay, growing by 11%. It's kind of interesting that the street thinks maybe just 2023 is kind of just like a down year because things have been a little challenging with the macroeconomic environment and things will kind of pick back up. But it is interesting. It's always interesting to see companies increase their revenue over time versus decrease, right? Just roughly speaking, you can see the street thinks like, I know we discussed that these are not very reliable, but the street thinks that Google will be able to maintain around 10% for the next 5 years or so. I don't think I want to go too much less than that. And so we basically, I do, even though these aren't super reliable, I think it is kind of instructional. I don't want to go too far away from what this is here. So I think honestly, we can just decrease this down to, I think it's good to be a little bit conservative with your models. So I think growing this down to 9% would make sense for me. So 2028, we'll make it 9%. No, what's up with this font? Okay, so then we're just gonna divide, linearly kind of grow it down. And so to do that, we get previous year minus the difference between previous year and last year, then divide by the number of years. Okay, so yeah, I think that's pretty conservative, and we'll have an optimistic case that's not conservative, but you know, I guess it's conservative based on the street. But if you think about it, this also just makes the assumption that Google will be able to maintain all of the growth that it has so far at an increasingly larger scale, which is always a challenge, right? Like going from even 100 million to $1 billion in revenue is a lot easier than going from 282 billion to even like 500 billion, right? There is probably still a lot of market left to capture in a lot of the spaces that Google's in, but 10% double-digit growth for a company that's already at $282 billion in revenue would still be pretty impressive. In contrast, like if you guys saw the trading comps earlier, last year Apple grew 0% revenue growth, and then this year is growing 6%. So, and then in the conservative case, I think what we want to do is just take like a haircut from all of this. So let's say, let's think here. I think for 24, 25, so there's two ways I'm thinking about doing this. One is for 2024 to 2025, since these are a little bit more reliable, taking like a smaller haircut with those and then growing it down to a revenue goal of, let's say, like 7% or 6%, 5%. The other thing we could do is just like apply a very standard haircut across all these numbers. So let's say for example, like 90% of all of this. And then for optimistic case, like 110% for everything. I think what would be a little bit more accurate is doing the first method. So let's just say that things are 90% of 2024 and 2025. And this is where modeling is really just like an art rather than a science, because, you know, it's really just a decision I'm making, not really something like I'm doing by some textbook formula, right? Okay, so next let me do the same thing as we discussed before. And this conservative case, I think, is pretty conservative, growing down to 6%. And then let's go the opposite way, where things are a little bit more on the optimistic side. So let's say this overshoots by 210%, and instead of growing down to 6%, it grows up to, I don't know if that makes sense. You wouldn't want to see something growing up over time, right? Let's just do these first 2 years first. I think what makes sense to me, like I don't want to, well, actually, what percent is this? Okay, 11.8%. I think what I would rather do instead of growing it to a certain percentage is, okay, so the reason I'm going to do what I'm about to do is, this is around 12%, 11.8%, as we saw here. And if I were to make the final year like 12%, then it would be growing up to 12%, right? And as we discussed, like having a company grow revenue growth over time when you're at this scale is pretty like hard. So instead of like growing it up to 12% or whatever, it's going to get rid of this, and just our optimistic case is just going to be the same, where we're multiplying by 110% to our street case or base case. But I guess this is pretty conservative, I'd say. There's not like a huge difference between our optimistic case and our street case. I don't like that, actually. It's 9%. Maybe make this, if we make this 8, let's see. Okay, given that we grew in 2023 8%, and then last year was 10%, 5 years down the line when the company's even bigger, I think actually 8% makes sense. And then this is around 8.8%. This is 8%. Okay. Just thinking here. Yeah, these aren't huge differences. But given the company's size, I don't think there's going to be as much, there shouldn't be as much volatility either. So, okay, I'm okay with this. So we're going to make things dynamic by using our offset function. So offset, you're supposed to reference the cell that you're in, which is this one. And then you go to your switch. Press F4 to lock it in. 0 for columns. And that should work. And then so you get your previous year 1 plus your growth rate. Okay, so those are our estimates for our, right now it's on our conservative case. Let's see what happens when we're on our base case. Okay. Okay, so I might change these numbers a little bit later if like things aren't really dynamic enough, but let's just leave that for now. Okay, so then we're going to need our conservative to our optimistic case for our EBIT. Street case, let's link to our percentage of sales here. And then for the first 3 years, these are going to be similar to our revenue. We're going to have it be just what the street has already estimated. And then again, these figures that we have, not super reliable, but are instructional. They just show like an increase over time to 32%. I actually kind of like that because for margins, you do want to assume that as the company becomes more and more mature, that they are able to become more and more efficient. And that's just like with every company, right? Just imagine anything that you do and learn, you get better over time. And so for companies, like what this means, to use that analogy, like let's say you're playing like soccer or something, you just first learn how to play, then you're like bad at kicking, bad at passing, like bad at running, you're bad at everything. And so companies, when they're younger, they're bad at like spending on marketing or wages or like entering new markets. Like everything's more expensive and less efficient for the most part because like you just get better from after learning from your mistakes. And so for companies and their EBIT margins, they usually increase over time because as your company grows, like you just become more and more efficient and better at doing what you're doing. So growing to 32%, I think, let's see, it's possible for sure over the next few years. Yeah, I think that's fine. So for our base case, we're going to grow to 32%. So that here. And also, by the way, for these like large companies, a lot of times when their revenue growth starts to slow, they also do focus a lot more on being more cash flow positive. Like that's what Apple, even though Apple has been not really growing fast in terms of like revenue growth, they have focused a lot on profitability. And that's what's really been like helping boost their stock over the past like 5 years or so. Okay, 32%, honestly, actually, might be a little bit too aggressive. I'm just going to have 31.5%, just slightly less. Okay, and then conservative case for the first year, just make it the same. 24 to 2025. I think for this, for both our conservative and optimistic case, I'm just going to do like a haircut. So EBIT 2024 to 2028. Let's say 90%. then 110%. For some companies, when I do this, like I would want to sensitize a lot more, but because Google is so, ooh, wait a minute. Oh, because Google is so mature, I don't think I want to sensitize like too much. Okay. Okay. Let me see if there's any questions in chat before I move on, because we just finished a big part of the whole model. Build the M&A model. So I do want to build like the accretion dilution model, but then I need to like brush up on it a little bit and, you know, kind of practice before I kind of like work on it and show you guys. But been pretty busy, so I haven't been able to get to that. I'll try to get to it when I can. Cash flow items, they're hidden right now. They're here. Okay, I see something written in Korean and okay, I see it says I'm a Korean student. And thank you for like the good, I actually don't really know what that says. But I think it says something like thank you for like showing us like something helpful and useful. Okay, so we have our switch for our EBIT. Oh, messed that up again. So offset, reference the cell that you're in, and then go to your EBIT. Also, as I work on this, I am curious to know for everyone who's on here, like, what do you guys watch these streams for? Are you guys actually trying to invest? Are you just like students or people trying to like go into banking? Or do you just like randomly watch these because you're somewhat interested, but you don't necessarily invest and you only invest in index funds and not individual stocks? I'm curious to know, why you guys watch all of this. Let me know in the chat. But so let's see. Just trying to think about if these numbers are variable enough. I do think growing up to 33% would be really good for Google. I'm pretty optimistic. So, okay, I'm okay with these numbers. For taxes, I don't want to really sensitize on this because taxes are always like things that companies do a lot of like crazy things with. I think taking a 5-year average is fine. It'll be a little bit of a shortcut that we use. Okay, so taxes multiply to our tax rate. Okay, EBIT is our EBIT. EBIT, I mean, is our EBIT minus our taxes. Oh, and by the way, I forgot to give you guys a reminder about this, but actually, you probably saw it from the thumbnail, but this model, after I finish it, will be available to download for free. So if you wanted to, like, after this video is published, you want to play around with the model or like build it from scratch yourself and watch this as you do that, then, feel free to do that. Changes in network capital. Okay, so let's see what people said. I'm a new investment analyst and eventually want to start investing. Great content. Awesome. So I love finance and the theory, but banking way out of range. break into M&A or IB, invest my own money, usually look into multiples and macro events. Second year student trying to get into banking. And then questions about modeling. So seems like a lot of students / like some investors. So interesting. Okay. So these figures I'm not going to sensitize on because they're pretty stable. And honestly, when you're modeling, this is what you love to see. It's when numbers are just very consistent across the board, because that means you can just kind of use historical averages and not really worry too much about it. So for Google here, what I'm going to do is, yeah, actually I can copy paste this. Yeah, usually it's either like a 3-year average or a 5-year average. I'm just going to use the 5-year average. I'm going to do the same thing for CapEx. Actually, CapEx has been decreasing, and so I'm going to use the 3-year average. Same thing for CapEx, and same thing for change in net working capital. So we get our percentage multiplied by sales. And because I anchored the row, like the second number to the row, I can just multiply this and then be super fast. Okay, so now we built out the DCF. We can get our unlevered free cash flow. Then we're going to need our present value of free unlevered free cash flow. So what this is our EBIT plus our DNA minus our CapEx minus our change in net working capital. All right, and then to go to our agenda, we did situation overview, we talked about trading comps, talked about Wall Street prep, did DCF, and now we're getting to our WACC and mid-year convention. Then we're going to do sensitivity tables and then a price discussion. So first, let's do mid-year convention. So let's do like period and then like discount period. Oh, and I love how helpful some people are being in the chat. It's awesome. Okay, so year end is 12/31/23. So I kind of had some issues with this formula in the past, but hopefully it's okay. So right now, if we look, we built like a quote unquote 6-year DCF, but in actuality, it's really, in my view, more of a 5-year DCF because we only have 1 month of projected cash flow left. So what I mean is, like in the year of 2023, we have this $56 billion free cash flow figure, but it's not that we're going to actually be getting 56 billion of free cash flow as Google, right? Because you only have when you're projecting out your figures in a DCF, you're only summing up the future free cash flows. So even though we're in year 2023, we're not going to use this full figure. And what I'm saying will kind of make more sense as we continue doing this. So in terms of the discount period, what we're going to need to do is essentially get the number of the kind of like fraction of the year that is left and divide it by 2, which makes it mid-year convention. So let me explain what all this means. So we're going to use the year frac formula. Get our starting date today and then our end date. Things are a little laggy. of everything I have turned like because I'm like streaming, and then have like different other tabs open and like all of that stuff. So, but anyway. Okay, perfect. So what this formula did for us is basically just calculate the percentage of the year we have left. So we have 0.19 of the year left, or 0.2, so 20% of the year left, or something like that, around there. Now we don't want to just discount back 0.2. We actually want to apply something called mid-year convention. And to explain this concept, when you're projecting out your future free cash flow for DCF, and then you want to discount it back, if you discount it back by, let's say for the next year, like 1 full year, then you're basically implying that I'm going to get all of this free cash flow at the end of the year, if it's like 1 year from now. But what actually happens is like you're, as a company, you're getting free cash flow like every day, if you're free cash flow positive. Because imagine if you're like at a lemonade stand or you started a lemonade stand for 1 year, and then you're constantly like getting cash and putting in your cash register as you're doing business and you're profitable, then you're not getting all the cash or profit that you earn at the end of the year of operating your lemonade stand, right? You're every day getting a little bit. But, you know, if you want to actually calculate, you know, like discount based on like every cash flow you get every day, and then discount it to like the exact amount of time that has passed, that is like extremely complicated and pretty unnecessary. So what mid-year convention does is makes like a very simple assumption that instead of getting your cash at the end of the year, you get it at the middle of the year. So all of that is to say, we're just going to divide this by 2. And so for our year 2023, basically what we're assuming is that our cash flow, we get it at the middle of the amount of time left from today until the end of the year, which basically will mean that we get it around like late November or so. Okay, so, and then what we want to do is, let's see, add this plus, and then we want to get it basically at the middle of this year, which is going to be June of 2024. So to do that, we're going to get this number. I'm going to multiply it back by 2. So that gets us to the end of 2023. And then we're going to add 0.5, because 0.5 of a year adds 6 months. And then from here, we're going to add 1. So this, at this point, when we're discounting, this discounts us to June 2024. And then if you add 1 full year, this gets us to June 2025. And then we can just keep adding 1. Okay, so I actually realized like one thing that I didn't do in my previous models that I probably should have done is for this first year, we're going to need to get the amount of cash flow that's relevant for the remainder of this year. Like we're not getting this full amount of cash, right? So essentially what I'm saying is for this first year, it's going to look pretty different what we do. So we get our present value of free cash flow. Actually, we need to do our WACC first. Oops. Let me pull a template of sorts to save some time. I see a question about when you can where to download the file. Obviously, the file is in progress, so I cannot give you the file yet. I will give the file when I'll update the link in the description after I finish this stream. Okay. Okay, so how long has it been since it's been 1 hour and 25 minutes. Take a really quick stretch break. finish out this model. Okay. So we're going to calculate our WACC. Let's get the Google's current market cap, which is 1.8 trillion almost. I guess can't. 1789.6. 1789600 because we're doing everything in millions. This looks wrong. Oh, didn't add the zeros. So this is in millions, and so it's $1.8 trillion of market cap. Risk-free rate. Let's go to our 10-year treasury yield. So currently it's 4.84%, and what the risk-free rate is, it's just like it's in the term risk-free, meaning if you were to invest in some kind of security and feel like it's risk-free and get a certain rate of return, what would that be? And of course, nothing in life is really quote unquote risk-free. There's always some level of risk, but people kind of accept that the US 10-year treasury yield, if you invest in treasuries, the US will give you this return because they're like reliable. Now, of course, like with interest rates rising and things going all crazy, like who knows like how reliable everything really is, but I do think it's pretty reliable right now, at least. You just can't rely on something like that forever, I guess is what I'm saying. And then in terms of beta, 1.23, this is like just a measure of how volatile is Google compared to the rest of the stock market. So 1.23 means it's basically 23% more volatile. So I think if I'm correct, it's like if the stock market were to move up $100, then Google could move up like $123, or the opposite of that, which is like $78, $75 or so, or 77, something like that. So it's like a measure of volatility in a sense. Market risk premium. We can get from this professor from wait a minute, risk-free rate beta. Yeah. So this professor from NYU just like posts this every, month or so, just because he's a nice guy, essentially. So implied equity risk premium on October 1st, 2023 is 4.47%. Just going to do that. And this calculates our cost of equity, which is our risk-free rate plus beta times market risk premium / equity risk premium. So essentially this just says that Google has a cost of equity of around 10%. This, I would say, historically is higher than what Google is used to, and that's just because the risk-free rate has gone up so much as interest rates have risen. So I think like we're going to get a pretty high WACC, and it's not necessarily going to be like super reliable, but let's just go with it for now. And then let's find out how much debt Alphabet has. Okay, so balance sheet, cash and cash equivalents, marketable securities. So these two are how much cash Alphabet has. Oh, oops, we need that. What am I doing? Long-term debt. Is there any short-term debt? Accounts payable? Nope. Okay, they only have long-term debt. So it looks like 13 billion in long-term debt, which sounds like a lot, but the company is actually massive, so it's not really a lot. Cost of debt. interest. Or interest rate. As of June 2023, we had 10 billion of revolving credit facilities. Okay. So no amounts have been borrowed for the credit facilities. So that is not their debt. We just need their long-term debt, which is in their note 5, which hopefully we'll get to. Effective interest rate 0.57% to 3.38%. So it doesn't really give us like a number, like a rate. Interest expense, maybe? So Google has around 15 billion in debt, and the interest rate is anywhere from 0.57 to 3.38%. I'm just going to take an average. And you can see that the debt is really just 0.76% of Google's capitalization. So it's not going to really affect our WACC pretty much at all. So average 0.57% and 3.38%. Gives us 1.98%. Tax rate, let's just use what we had in our DCF. 17%. Again, not really going to affect our information too much, or our WACC too much at all. So that gets us like, this is like our total capitalization, which is 1.8 trillion. And that's just our market cap or our equity plus our debt. And then to get our WACC, it's this formula here, which is your percentage of equity times cost of equity. And because equity is pretty much all of Google's capitalization, it's pretty much our WACC is essentially equal to our cost of equity. But you do that plus your percentage of debt, which is 0.76%, times your cost of debt, which is around 2%, times 1 minus our tax rate, because there's a tax shield, 17%. So then our WACC is 10.27%, very, very close to our cost of equity of 10.34%. Now, normally, or just like, let's say 2 years ago or so, our risk-free rate, let's see what it was. So around 2020, or when interest rates were at the lowest of all time, like, so right now it's like, you can see up here around like 4-point-something%. Back just 2 years ago when things were at an all-time low, it was 0.56 or 0.5%, 0.55. And you can see that makes the WACC 6%. And if you know like how DCFs work, if you have like a really low WACC, that's going to shoot your value of your company really high. And so that's why this is like one explanation as to why people are very nervous when they're like investing in stocks when interest rates rise, because now you're kind of looking at companies with a much higher WACC. With that said, and that'll bring valuations down across the board, right? Now, with that said, it's a little bit tricky because like, do we really want to use this 10%? Like, is this the new normal? And do we want to consider this to be like our WACC that we use for the valuation of Google when we're trying to value the company from now until the end of time, right? We'll kind of discuss that a little bit when I sensitize everything, but with that said, let us oops. Okay, so our WACC for our base case, we're just going to use the WACC that we actually calculated. And then for our conservative case, honestly, this is already really conservative. So I'm just going to make this like 10.5%, which is still like insanely high. And then for our optimistic case, our conservative case, kind of go more towards like what I personally think makes sense, which is around 8%. You could argue that it should be even lower at like 7%, because the way you want to think about cost of capital is for a company, you know, it's essentially if the company wanted to raise money, what would they kind of need to pay? And if you're a more mature company, then your cost of capital decreases because you're more trustworthy and people kind of won't charge you as high interest rates and all that. But then if you're a very, very young company and you need to borrow money, obviously people are going to be like, hey, pay me a higher interest rate because I'm taking on more risk. So let's just make it 8%. I still think like you could argue that it could be even less. And we'll use the choose function to for this part. Okay. And then terminal growth rate, just really standard, 2.5%, 2%, and 3%. All right. We're almost done, guys. So back to what I was saying before we had to go to our WACC. So we're only going to take a certain percentage of this cash flow, right? Because 80% or so of this cash has already, you know, it's already in the past. And now we just need to take like a certain percentage or a certain amount. Wait, let me think about this. Yeah. So we'll get our cash flow for that year, multiply this by the amount of cash flow that's pretty much left, which is what we've calculated in the past, which is recently in this stream, which is our year frac. Start date, and then our end date. Things are a bit laggy. Oops. So, okay, I totally pressed enter way too quickly. So, but basically what we've done so far is we've gotten our cash flow and multiplied by the year, the amount of time that we have left essentially in the year. And this gets us to our cash flow figure. So 10 billion essentially. And then what we want to do is discount this figure back to present value. And how much are we discounting? The number, our discount period here is, as I explained earlier, the percentage of the year essentially, but half percentage of the year that we have left, which is around 20%, but assume that we get it in the middle. So which is like basically 0.1 years later, which is about a month later. So what we want to do here is we want to get our cash flow, and then divide this by 1 plus our WACC. I want to do one quick thing actually before we do this. I'm going to name the cell here WACC. And it's just going to make it a lot easier to reference, and TGR, so I don't have to like keep going back up. So we're going to get our cash flow for this year. And then divide by 1 plus our WACC to the power of our discount period. Okay. And then for the rest of these numbers, like things are going to be a lot simpler. It's just getting our free cash flow figure divided by 1 plus our WACC to the power of our discount period. And then for the rest, we can just copy paste this across. And you can see that the present value is lower than our like projected value. That is what we want to see. All right. And then we have to get our terminal value and then present value of terminal value. And then we can get our enterprise value. We can add our cash, subtract our debt. That'll get us to our equity value. And then we can get our share count and then our implied share price. So terminal value is our last year's free cash flow, last year projected free cash flow, plus 1 plus your terminal growth rate. All of this divided by your WACC minus your terminal growth rate. Very standard formula that all bankers need to memorize. And then to get our present value, you get our terminal value, 1 plus our terminal growth rate to, 1 plus our WACC to our discount period. Cool. So then now we calculate our enterprise value by getting our average of our present value of free cash flow and then our present value of terminal value. Okay, definitely did something wrong here. Oh, I did average. So we need to do our sum of our free cash flows and present value of our terminal value. Add cash, which we had over here before in our balance sheet. Oops. Balance sheet. Okay, as of June 30, 2023. And by the way, one really quick thing that can be a little tricky when you're first on the job in banking. Companies organize their balance sheets and like financial statements differently. Sometimes they'll have the most recent one in the first column. Other times they'll put it in the second column. And every analyst probably makes this mistake at least once of pulling numbers from the wrong column until you make the mistake. And then your associate says that you like messed up. And then you look, and then you like always pay attention, which column should I be pulling from? There literally will be companies that have the most current figures in the first column. But in Google's case, it's in the second column, which is for me a little bit more intuitive. So anyway, total cash is 118 billion. And our debt we can just get from our WACC. We already got that figure. You can already just see, Google is just so well financed or positioned. They have 118 billion in cash and 13 billion in debt. And you might be wondering why does the company even take on debt? And it could be because there was, really low interest rates. And so the company thought it'd be better to take on debt to fund any kind of business expansion that would give them a higher percentage of return versus their interest rate that they're paying. It's very common for companies, even in these positions, to take on debt. Anyway, so enterprise value plus our cash minus our debt gets us to our equity value. And then now let's get our share count. And fully diluted shares outstanding, 13 million, I think. All right, so we finally got to our implied share price. Now, don't worry if you're like, oh, this is too low or whatever, because we're not done. So 98.19 share price. what did I say we're going to do next? Okay, I said we're going to do sensitivity tables, so, and then price discussion. So I'm sorry if you are here mainly for the price discussion part, but a few more things we have to do. It's pretty quick though, but I think, you know, sensitivity tables sounds a lot harder than they actually are. I just want to sensitivity table / data tables. I want to show you guys how to do this. So essentially what this is, it's like a very simple concept. What we're going to be doing is looking at two different variables and seeing how it changes our implied share price. So the first step here is to link to our share price. And then you're going to have to like kind of decide like what do you want to sensitize on. So for a very common one for DCF is your terminal growth rate and your weighted average cost of capital, or your WACC. So for the WACC, let's link to this and our terminal growth rate. And actually, I'm pretty sure it's going to get an error if we actually link to it. So let's try this out first. And I see a question. Did you ever meet Jamie Dimon? No, I haven't, but I have seen him, I guess, because he came to talk to like the analysts and stuff. And I also saw him at the JPM healthcare conference because I used to cover healthcare companies, and there's like this conference that happens in January every year that JPM hosts. It's kind of like a big deal if you're in healthcare, but if you're not, like it's literally like not important at all. Okay, so this formatting is a little bit ugly right now. Let me fix it. Okay. Okay, so let's have this be referenced. And then we're going to have something called a step. Where would be good to have that? Step. And I'm going to make this 0.25%. So step, what step is just like how much are you going to decrease or increase something by? We'll see what I mean. So we're going to subtract by our step here. And then on the other side, we're going to increase by our step. So it's kind of like staircase-ish, if that helps. And then for usually what you do here is you always make this invisible by making the font same color as like this highlighted part. It just makes it a little like nicer, I guess. So here we also need a step. Should I put this? And we'll make the step for our WACC 1%. Yeah. By the way, this formatting is like for the steps and everything, not great, but whatever. So we have our WACC, terminal growth rate. So when you increase your WACC, that decreases your valuation. So for on the left-hand side, we want things to be decreasing valuation. On the right-hand side, you want it to be increasing valuation. So it's your WACC minus your percentage. And you guys will see once I make the data table what I mean. Okay, almost there. Just gonna make some formatting changes real quick. Okay, so to make the data table, what you do is you highlight. So we have this thing we're referencing, and what this is basically going to do is just calculate different figures of our share price based on these different changing assumptions. So you highlight like this area, Alt, and go to data, which is A, and then what if analysis, and then T, Alt A W T, row input. So this is like our WACC here, and we can go up here. So our WACC is what's being sensitized, and then our column, which is our terminal growth rate, okay? And then you press OK, and that should kind of populate everything. Now it says 0 right now, but if you press F9, it'll calculate everything. And you need to format this. Let's make this into counting currency. Cool. So one really good check is the middle should always match your figure that you're referencing. So I'll let you know what I mean. So this 98.19 should equal what you have here, which it does, right? Because the assumptions that you put in the middle here, you know, this 10.27%, this 2.5%, that's what we currently have in the model. So if this number does not match this number or like this number, then you clearly have done something wrong with your data table. Yeah, that's what a sensitivity analysis looks like. It's very common to build one for your WACC and your terminal growth rate, and you can also do it for anything, really. You can do it for revenue growth or EBIT margins. If you have like a CAGR of like how it's growing and all of that. But yeah, that's your sensitivity table. With that said, and I guess like one thing, this is the one reason this is helpful is, you know, we discussed earlier that a 10 point something percent WACC is too high. Then you can just, instead of like constantly going to your assumptions and changing everything, you can just like look at this or change the numbers and kind of see like, if I were to change, you know, these figures, how does my share price change? So if we have a lower WACC of 8.27% and a 2.5% terminal growth rate, then you can see the implied share price of Google is 129.64. And I'll go into this a little bit more, but let's first make some changes. Okay, so let's first make some changes. But I do see some questions here, or I see a question here about usually first line in DCF is net income. I don't know why you start with EBIOT. There's different ways to build a DCF, but you know, net income, I would argue you don't want to start with that unless you're adding back your taxes and your interest, because for DCF, you always want your unlevered free cash flow. If you start with net income and then add CapEx or add DNA and minus CapEx and minus change in net working capital, then you're getting your levered free cash flow. And then you're not getting to enterprise value. You're getting to that means you're getting to your equity value. So that's why, that's one reason you start with your EBIOT. But the other reason that you do project out your revenue and EBIT is because a lot of times your cash flow items here are as of a percentage of sales. So imagine we only had net income, and then we're trying to predict our DNA, CapEx, and change in net working capital, and also our EBIT. I guess, okay, so sorry, I take that back. If you have your net income, you wouldn't need your EBIT per se. But in order to project out these cash flow items, usually want to do it as a percentage of sales. If you don't have it projected for your 5 to 10 years, then how are you going to project out your DNA, CapEx, and change in net working capital, right? Okay, anyway, let's go to our price discussion now. So implied share price based on the model, current share price of Google as of the 24th. So let's see what that is. And as a reminder, Google is going to be releasing its earnings today after close, which is in like 3 hours. So it'll be interesting to see how the stock like kind of performs, and also how close like our valuation or my thoughts on valuation is based on the numbers. So currently Alphabet is trading at $138.17. Implied share price, 98.19 based on what we have in the model right now, but it's not really what I believe, or what I don't think it's what I think we should. It's not what I think we should use. At the very least, I think our WACC should be lower, and so that makes it 135.69. In terms of revenue, EBIT, I think there's an argument that could be made that it should be, these should be higher. So like if you look at, let me hide these figures. Okay, so if we look at all this, remember that these are not like sensitized, or these are not hugely different. But again, that's because Google is already so large. So I would say that being more conservative more optimistic with our WACC, like that's what I would believe. Terminal growth rate 2.5%, I think that's pretty fair. Revenue and EBIT, I think like if you really are bullish on Google, then I think like if you're trying to be conservative and trying to build yourself some margin of error, the conservative or the street case is like relatively reasonable. And then if you were a little bit more on the optimistic side, make this into the optimistic case, and that implies Google's share price should be 149.13. So that's kind of where I personally stand. And one thing I do want to show you, and it's not 149.13, by the way, it's the range. And I think 149 is kind of the max. So I changed a bunch of numbers, right? But you can see that now what we have here, the data table, the numbers don't match. And that's because I changed some of the assumptions. Like what's a little bit non-dynamic with data tables is that once you calculate it, they stay at the same numbers. But if you press F9, it recalculates everything. Wait, but this is still wrong. Oh, it's because I needed to change these numbers. So now it matches. And normally, actually, you don't need to. Let me try seeing if this works. Yeah, for some reason that doesn't work. That's so weird. Yeah, I think you need to hard code it for whatever reason. Or maybe there's something I'm forgetting. Anyway, so now let's say that you were thinking about like Google's implied share price, and you think that based on the the optimistic case, you think like a 7% WACC makes more sense, or like a 2.7% terminal growth rate. Then you think like, okay, Google's share price should be 189.16. So that's kind of how you use the data table. So just to kind of like recap really quickly of what I think the range of what makes sense to me and what is fair is somewhere around like 135.69, maybe at a max to 149.13. I think that's, based on what we have, pretty fair for Google. Now, with that said, could there be better opportunities than earning pretty much like a 10% increase in share price? Like probably. So I don't know if Google is necessarily like the best stock to buy per se right now. in terms of like opportunity cost and all that, but it would also be very, very stable. And obviously is like a very strong company. I think what's, helpful with this is, let's say Google's share price does tank for whatever reason, like macroeconomic reasons. They just have like one bad earnings report, but the stock, the investors like just overreact and the share price goes down over the next year to like, I don't know, $100. And you build out this DCF and you think that the share price should be something like $140, $150. Then, there's a 40-50% upside if the share price is at 100. So then that's where I think, even if you build this out and you're like disappointed because you're like, oh, I just built this model and like there's not a lot of upside, at least now you also can kind of have a basis for, if the share price does decrease, then maybe I have a better understanding of when I should buy, because then I'll have more upside if it does go down. And I think investors are overreacting, or like you're bullish on the company or something like that. So yeah, that's pretty much the model. I'm going to save this, clean it up a little bit as needed, and then upload it. I think the link will be ready maybe around like the end of today or maybe tomorrow. So feel free to check out the link that I'm going to be posting in the description if you want to download this model for free. I also have like a link for a Google form where if you want to be updated like in advance for when I'm going to be doing these streams, or just like be sent the model link, I'm going to try to work on like an email update kind of thing, so that you can be more, you don't have to like I just stream these whenever it makes, whenever it works for my schedule. So if you want to get noticed in advance, then sign up for that. There's a link to like signing up down in my description right now. So yeah, and last quick reminder about like our sponsor, because I do think this is a pretty cool kind of like financial modeling course that's probably pretty underrated right now. There's this buy-side financial modeling course that has 82 lessons, 6 hours, $319 if you use my code RareLiquid, and it's taught by a guy who actually worked at a hedge fund at Maverick, the eShock, and Citadel. And you learn a ton of just very detailed modeling exercises and processes. So things like revenue build, I think, are super, super important. And how to forecast, how to think about if this is a good business. You go into a lot more detail than what we did today. With that said, I did promise that I would leave some time at the end if you guys have any career-related questions. So let me know if you have any questions in the chat. I'll wait a little bit for like 20, 30 seconds. And yeah, for that to populate, because sometimes the chat, the questions are a little bit, they lag versus like when I'm actually, versus like the time of when I'm talking. All right. So what do you think about going into equity research, and which jobs in finance do you think AI will take over or reduce the headcount? That's a great question. In terms of equity research, I think it's pretty niche, and I think if you establish yourself and really enjoy the work of like looking into companies and like you enjoy the markets, it's a pretty interesting field. But I will say that the headcount is very, very tight in equity research. Usually you have like an analyst. It's also confusing with the titles, because analysts for equity research just means, people, as you like growing more and more in senior, you can be just an analyst forever at equity research. Like that could just be your title, even though you might have been there for like 20 years. Because you still call them equity research analysts, even if they've been there for a while. But anyway, like I think equity research is, personally, I wouldn't recommend it, because there isn't that much room for new people, because once you have like a very senior equity research analyst, it's a pretty good gig. You've developed a relationship with the client, so the bank or the firm doesn't want to let you go. And then so like you don't really have a lot of new analysts like all the time, versus like, or new spots, versus in investment banking or like consulting or like accounting, you have thousands of people joining these firms every year. In terms of which finance jobs will be replaced by AI, I don't know for sure. I do have a video about like how AI will affect investment banking, and you can check that out on my channel. It's like one of my, I made that like 8 videos ago or so. But I think AI will be a tool, at least for the, let's say, next 2 to 3 years. Won't necessarily replace a ton of finance jobs, because the accuracy that you need for auditing and accounting or like investment banking, you can't really get that with AI right now. And if you have any issues, like even with FactSet, for example, like you can automatically populate a ton of financial figures. But even in banking, we always had to make sure that every number was correct. And so I don't think that there's going to be a huge change in the next 2 to 3 years, but 10 years from now, I think no job, quote unquote, might be safe. Like who knows? Next question. Google earning is tonight. Are you going to bet that it will pop or drop after earnings? Honestly, I'm not sure, because I have not been following Google stock closely. So I don't really know. And plus, like, that's really hard to predict. Shouldn't you check if the reinvestment, CapEx plus minus DNA plus change in net working capital is coherent with your projected EBIT growth? Maybe your reinvestment is not enough to justify it. Interesting. So should you check if your reinvestment, CapEx minus DA plus change in net working capital? So let's see. I'm wondering exactly what you mean. I think that could be interesting. I think this is what he's saying. So let's get our CapEx minus our DNA plus our change in net working capital. Okay, and then if we were to get the percentage for this, the growth, and kind of compare this to our EBIT growth. I guess this could be like a sanity check. Honestly, I haven't done this analysis before. I think it's pretty interesting. If I'm doing this correctly, based on who suggests this, Eduardo. So essentially, this is like CapEx minus our DNA plus our change in net working capital is kind of like the cash that we're needing to reinvest back into the business, and then looking at this growth rate and like how much we're kind of putting in and comparing that to our EBIT growth. I guess, honestly, I would have to think. I don't know if I can think on the spot of what the trend should be. Like, should these be kind of like close to each other as the years go on, which it is what we're doing. Maybe like that makes sense. But anyway, here are the figures since you asked for it. I'll think about that maybe and incorporate it in a future stream. Next, are the M&A models exactly like this, or are there more details? If I know how to do this type of modeling, am I ready to work? I think so. This is like very, very high level. I would say the very complex models that I built have been very complicated on the revenue build side. And so you'll have a lot more tabs. Actually, for any company, this is like any industry. This is really, really just like table stakes and very simple model. So I would say that, no, you would definitely have much more complex models in banking. Doing this will be a good starting point. And I think if you were to start, like when I started my banking job, I knew none of this. Like I barely knew how to use Excel. So if you do know how to do this, like everything that we went over today, if you know this for the job, before your job, then you'll be at a pretty good state. But you also need to learn how to do LBOs. You also need to learn how to do accretion dilution and trading transaction comps, but comps are pretty easy. Do you think PE is better option than hedge fund after 2 years in IB? That question is really just dependent on what you enjoy, and career related questions, it's very personal. If you really like the markets, investing and all that, then, you should probably do that. If you really, really like, really digging super deep into a company and diligencing it and making long-term investments, then private equity is probably better. Why are your taxes expressed as a percentage of EBIT? Because for your unlevered free cash flow, you don't want to take into account interest expense. And so we want to calculate our earnings before interest and after taxes. So our tax rate, our taxes are as a percentage of EBIT. Wait, did I do this correctly? Let me think. All right, it's up there. Oh, so it's the way that, let's see. Oh, so it's because of the way I modeled it. So I think what I said is kind of partially true. You can, let's see, taxes, percentage of EBIT. You just need to be consistent. So, wait a minute, let me think. So what we did here was got our taxes and divided by our EBIT to get our percentage of EBIT. And that's how we found our taxes. And then so if we apply something similar down here for our taxes, then it's like consistent, and so it should be fine. So I think it's just a matter of how you want to do things. Let's see. Yeah, actually, I kind of take back what I said. I do think that it would be better if this is just your actual tax rate. And that would mean it should be, yeah, thanks for catching this. It should be your provision for income taxes 2018 and divided by our income before taxes, our earnings before taxes. It's not really going to change the numbers much, but still, you want to be accurate. So these are the figures. This taxes. Okay, so then, yeah, let me fix a little bit. Or actually, everything else is correct, but we just want to make this our tax rate. Okay, so yeah, my bad. I do think this is more correct, where you're using your just normal tax rate. Wait, but then your interest. I'll add I think using this tax rate, using your normal tax rate. I think using your normal tax rate makes sense. Wait a minute. Oh, I'm getting myself confused. I think I'll probably I'll update you guys in the comments later and kind of dig into this and figure out what's correct. I kind of forgot, to be honest, but normally the reason I did it the other way is because you're eventually here multiplying your taxes times your tax rate that you use here. And then if we do it as a percentage of EBIT, then I was thinking that'd be a cleaner way to find the rate that doesn't include your interest expense. But I do think I should probably like look into it more, and then the updated model that I'll upload will be like the correct version. So let me just answer a few more questions and then we'll close the stream. How are MBA prospects with only 6 months work experience? That's way too short. I would definitely recommend like 2 to 3 years at least. Do you have any experience from working in DCM? I don't. I have worked with people. Actually, I didn't work on a lot of debt deals because I covered healthcare companies and biotech and medtech in particular, and they didn't really require debt. So I didn't work with DCM too much. But in terms of like my thoughts on debt capital markets groups, I think it's pretty niche. And if you do like debt for whatever reason, then you can like kind of keep working on that in that field. But if you eventually want to work in private equity or hedge fund or work on M&A deals, then I wouldn't recommend DCM if you can avoid it. But I do think like if that's your only option, you can start there and move to a different group. Okay. What do you mean by complicated revenue build? Can you give some more examples? Sure. So I had to build a revenue build for like a biotech company once. And you start out with like the total US population and then find the addressable population for multiple different drugs. I think at that time I had like 5 different drugs. And then you calculate, so you get the addressable population, you get the number of people who are likely to take the pharmaceutical drug, and then you multiply it by the price. Then that gets you to like your revenue stream for one drug. And you have to do that for multiple drugs. And just like calculating from the US population of like 300 something million, and then eventually getting to your revenue, like projected revenue for any product, that's like very complicated. And like all of that is all the work you need to do. And you build different cases for like every part of that probably, or a large number of them. So you can just have like, we just built a DCF that has, 100-ish or 80-ish rows, but you could have like a revenue build that goes for like 100 to 200 rows. And that just gets you to your revenue. And then you calculate the EBIT and then and all the like the cost of goods sold and like the operating expenses. And when you're in banking, you have access to like more of this information. So you can just build out like hundreds of rows just for your income statement. Okay. That's going to be it for today. Thank you guys all for joining. Appreciate it. I will, as I mentioned, update this model that's like fully correct and everything as a link down in the description so you can check that out. With that said, hope to catch you guys in the next stream and in other videos. Thanks, guys.